is account types. So before we proceed to the accounting types, I have here the theory of account types. We have here the real account, personal account, and nominal account. So in a real account is a general ledger account relating to assets and liabilities other than people accounts. These are accounts that don't close at year end and are carried forward. So this is all about relating to assets and liabilities. So when to debit, account of goods or assets coming into the business is to be debited, and when to credit, accounts of goods or assets going out of the business is to be credited. Next one is the personal account. It is a general ledger account connected to real persons like individuals, firms, and associations. An example of a personal account is a creditor account. So when to debit, if a person receives something from the business, his account in the books of the business is to be debited. And when to credit, if the person gives something to the business, his account in the books of the business is to be credited. And the third one is for nominal account. Is a general ledger account pertaining to all income, expenses, losses, and gains. An example of nominal account is an interest account. So when to debit, account of expense or loss is to be debited, and when to credit, accounts of income or gain to be credited. So we have here the nominal account. So it's a general ledger account pertaining to all income, expenses, losses, and gains. An example of nominal account is an interest account. So when to debit, account of expenses or loss are debited, and to credit, accounts of income or gain to be credited. So we have here the account types in accounting. First, we have assets accounts. So in assets are accounts, these are the assets are the physical or non-physical property that adds value to your business. For example, your computer, business car, and trademarks are considered assets. Assets accounts includes gadgets, equipment. So here are the examples. We have checking, petty cash, inventory, and accounts receivable. So although your accounts receivable account is money you don't yet have, it is considered an asset. It is considered an asset account because it is money owed to you. Owed means having an obligation to pay or repay. So again, assets are increased by debits and decreased by credits. This means you debit the corresponding sub-assets account when you add money to it. Okay? Means you debit the corresponding sub-asset account when you add money to it. And credit a sub-asset account when you remove money from it. So the second account types is the expenses account. So for expenses account, any product or service that your company purchases to generate income or manufacture goods is considered an expenses. These are the example: advertising costs, utilities, rent, and salaries. So for example, you may deduct direct labor costs and business-related travel costs, but you cannot deduct personal expenses, donations, exchange loss, and penalties. Third one is the revenue or income. So here, one of the primary types of accounts in accounting includes the money your company earns from selling goods and services. This term is also used to denote dividends, and interest resulting from marketable securities. Here is the examples of liabilities accounts. So here we include the debts or obligations payable to creditors and other outsiders to which your company owes money. What money you have? So you have the loans, unpaid utility bills and car loans, bank overdrafts, and mortgages. So last is the equity accounts. Defines how much your business is currently worth. It's the residual interest in your company's asset after deducting liabilities. So we have here the common stocks, dividends, and retained earnings. So I have here the picture of AT. So to assist in visualizing the effect of recording a debit or credit amount and the resulting balances of a general ledger accounts, it is helpful to draw IT account as shown here. Okay, for the next slides, we have the account title and the left side for debit and the right side for credit. So since every transaction will involve at least two accounts, we recommend that you always begin by drawing two T accounts. For example, if a company pays its rent of 2,000 for the current month, the transaction could be depicted with the following T accounts. So it belongs to the debit sides. So note that one T account is for rent expense as a debit of 2,000 and that 1T account for cash as a credit amount of 2,000. Hence, the transaction had debits equals to credits.